Good morning, traders and investors. Today is Tuesday. It's July 26th. It's the last week of July. The market's going to open up in a little less than 2 hours, about an hour and 57 minutes to be specific with you. I am leaving for New York in about an hour. Actually, I'll be leaving for the airport right after I'm done with this video. I will be around. If you have any questions, feel free to email me, support@marketgeeks.com. Let me know if I've been helping you navigate these markets. Support@marketgeeks.com. If you have any questions you want me to answer, support@marketgeeks.com. And if you want me to cover any video topics, let me know. Support@marketgeeks.com. Now, I'll be doing my videos every day from New York, so I will not be leaving you hanging. So I don't give up just because it's my vacation time. I missed New York last couple of years because of COVID, so this is our first time going back. So I will keep you abreast of things. Markets are opening up down about, undoing most of what we did yesterday. NASDAQ is down about 68. The Dow's down about 138. Now, what's interestingly, and I am paying quite a lot of attention to this, is the following. I want to bring this to your attention. If you look at the ATR, the average true range, on a 10-day basis, which is fine, you will see, let's just get rid of that RSI. This is volatility. And volatility right now, I want to make this smaller. It's probably worth showing you. Let me do this display. Let's go to small. Small sometimes is better than large. All right. So as you can see here, the last time volatility was at this level was right here when we were basing out right before the market went down. So it's a very calm period for the market. And the question now is, with the volatility down, is volatility going to revert higher, or is it finally going to go lower? Because volatility has been at these levels for quite some time, and it's right now near its short-term support level. This is the short-term support level on volume. So if volume can go below 473, 450 points, we may be able to go a little bit higher on price. And that is the main factor right now. The question is, are we going to revert back lower, or are we going to go higher to the next level, which is the CPI level right here? Now, what's interestingly, if you look at some sectors like consumer discretionary, you will notice that we are also right in that area. And if you look at technology, you will see the same thing. It's very, very also right up there, just a little bit above that level. And you will also notice that the bond market is doing something similar, very, very similar. You can see right here, if you just move that a little lower, kind of breaking out. I think the bond market and consumer stocks are very, very correlated right now for obvious reasons. Matter of fact, if you don't believe me, all you have to do is look at the period when the market sold off and when the bonds sold off. You'll see that it happened within 2 weeks of each other. So the bond market looks like it's going to be in a range for a while between the 120, this is the TLT, the 120 and the 110 area. And I would be a seller around here because I don't think we're ready to break out to the upside just yet, unless the Fed goes crazy and shifts from 0.75 or 1, which I don't think they'll do, basis point hike to 0.50 or 0.25. I don't think they're going to change their tune just yet. They would be nuts to do that. But then again, we've seen it all from the Fed. So I think we're going to kind of drift in this range and not really break out just yet. And if that's the case, then the odds of us breaking out over here on the tech, on the consumer discretionary, is not that high either. So you want to really pay attention to the bond market right now, because it is giving us directional bias for stocks in the medium term. I mean, you can't ignore that. Look at TLT and look at XLY. I mean, I'm not the only one seeing a resemblance, right? It's not a coincidence, is it? You see that? Same song and dance. And look at stocks. Look at stocks like Amazon. You'll see the same thing with these discretionary stocks. They've been kind of sitting within a range. So the point being is, I think they're going to stay within this range, and I think we're going to just kind of stay choppy. And if that's the case, then volatility is going to start going down, just like it's been going down on all of these assets. It's actually on the technology now below that level, quite a bit below that level. Matter of fact, this is the lowest price or lowest volatility we've seen since the market started cooling off, which is kind of interesting. So it'll be very, very interesting if volatility can continue declining or not. Speaking of volatility, we have a short position or a put on the VIX right now, and it's like down 20%, down 10%. But it'll be very interesting if we can continue breaking lower. If we can continue breaking lower up to the 20 level, break down another 3-4 points, it would go a long ways to confirming that what I'm saying is true in terms of volatility right now, that volatility is ready to break lower. And if volatility is breaking lower, that means markets can go higher. Now, today, as far as Fed data, oh boy, we've got consumer confidence and we've got new home sales. These are pretty important reports. Consumer confidence a lot more important. Not as important as it typically would be, but because we have FOMC. But the range is 94 to 100. Last time we had 98.7. It would be really great to see that number above 96.8 because that's what's baked into this market right now. In terms of new home sales, even if the number is off a little bit, and I don't think it's going to be off a little bit, but even if it was off a little bit, and you can see here it's a pretty tight number, I'm not looking at too big of a deal. New home sales have been fairly reasonably moving along, and the fact that inflationary pressure is going up and it's causing a cool off into housing, that's expected. That's nothing big. Tomorrow's the big day. You've got FOMC and then you've got GDP. So we will be having some volatility. And I'll go into sector analysis in a minute. The biggest factor is investors bracing themselves for another Federal Reserve hike. Fed's meeting is expected to raise up to 0.75 of a percentage point, triple the usual amount. That would put the benchmark at 2.25 to 2.5, the highest since 2018. And I think they want to take it to about 3.25. We'll see what happens. Investors worry aggressive rate hikes by the Fed contain inflation that's at a 4-year high. Similar action central banks in Europe might derail global growth. It's a balancing act. So far, we're doing okay. We are at a 1981 high on U.S. inflation, but not on core. Core actually peaked out 3 months ago. And if it could stay that way, we may be peaking out. The U.S. economy is slowing, but hiring is slowing, but it's not in a recession. And Yellen said on Sunday, strong job market is evidence that the economy could stand higher borrowing costs. And that's exactly what I've been saying. If people are spending money, then we can stand with more borrowing costs. On Monday, Walmart shares fell 10% in aftermarket trading, lower its profit outlook. Companies said shoppers are cutting back on discretionary items, particularly clothing, that carry a high profit margin. It'll be very interesting to see how those luxury brands do in the next couple of quarters. On Thursday, Commerce Department is releasing the economic growth. We're looking for it to shrink to 1.6%. That's what's on the table right now, I believe. Let's take a look here. Let's just make sure we got our ducks in a row. Last time it was negative 0.6. Now we're looking for it to be above. Anything positive would be really good. I'd love to see this number at 0.7 or 0.8, but I'll take 0.5. Personal consumption is the big number, but this is the expectation. 0.5 positive for the quarter increase. If it's better than 0.5, we may get a rally. If it's lower than 0.5, well, you know what can happen. And consumption is 1.3. Now, also, we're watching earnings. Earnings. You don't have to go far. I've got the big ones for today. Google, oh boy, after the closing bell, and Microsoft. Google is looking at, you may want to write this down, year over year, $70 billion on their revenue, on a decline of 4.4% to $1.30. So let's see if they can go above $1.30. I think they can beat it. And Microsoft, I think they're going to match these earnings just perfectly. $2.30, which is a slight increase on EPS and a reasonable increase on revenue. Microsoft is getting out of the consumer business as much. They're more into the clouds and things of such nature. So their impact will be felt less, I think, than Google because Google has a lot of advertising revenue. So look for this number, 70 billion and a 130 per share, which is a 4.4% decline. I think they're going to decline about 2.5%. As far as sectors, we want to be very, very careful with our sectors. And I'm going to go through them with you right now and show you where the danger zones are. So financials look okay. They look like they can kind of hover around here. Energy is looking really good, which is not good for consumer stocks. Utilities is looking good. I think energy is going to go for another round up. Consumer staples are looking good. All of this is telling us that discretionary stocks are not looking good. They look like they're going to come down. So I'm looking for the next few days to be fairly positive for defensive stocks and some selling pressure on the technology, consumer discretionary, and where's communication? Communication's almost halfway done there anyway, so it's leading down. But all of these stocks that have gone up and showed us some promise in the last couple of weeks are now going to come back down, in my opinion. And defensive stocks like energy, utilities, consumer staples, possibly financial, depending on the GDP, and healthcare. I like healthcare and consumer staples the most right now because they are inflation safety stocks. So I do like these stocks. I do like industrial. I like basic materials, but I'm not too cool on the communication, on consumer discretionary and technology, especially going into consumer sentiment, going into FOMC, and going into GDP. I'm going to tell you this. If those tech and consumer stocks can withstand and trade higher after these three news, then we are a lot further along in getting out of this mess. And I don't think we are yet. I think we're going to congest for a while. We're going to be in a wait-and-see environment. But keep your eye on volatility. Keep your eye on volatility. Keep your eye on the consumer stocks. And if you see them revert back down to their lows, don't be surprised. If that means that we should expect more upside from energy and defensive stocks because they've been kind of sitting on the sidelines, but I think they're ready to move now. So again, don't be surprised to see some downside on speculative stocks and upside on the boring commodity style stocks that have been going up most of the year. I think this is the opportunity for those stocks to come up again because I think, unfortunately, we're going to be reminded later today, tomorrow, and on Thursday that we're not out of the danger zone just yet. Speaking of danger zone, today, what do I do today? I give you the strongest and the weakest sector. Folks, here's what I'm going to tell you. The strongest sector right now, would be consumer staples or healthcare. The weakest sector right now, communication services. Now, before I let you go, folks, something you've heard me talk about with fellow trader Jeff Zananeri and the massive outflows we're seeing from stocks and funds lately. For the past couple of weeks, we've seen investors pull money out of the market at levels not seen in years. Jeff says this cash exodus is creating a massive trade opportunity as we head into the Fed meeting today. And I mean, it's going to be on for the next 3 days, folks. And I tend to agree, but the trade is not likely what you're thinking. Jeff is up to something again. He's always up to something good. So make sure tune in today, 1 p.m. Eastern time, when Jeff lays out how he's playing the Fed's rate announcement. The info he'll be giving is timely, it's actionable, and Jeff is really good with these global events. And right now, FOMC, GDP, consumer confidence, you need Jeff Zananeri more than ever. Click the link below to register, and we'll send you an invite by Tuesday. By noon. I don't know. Today's Tuesday. By noon Eastern time today. I'll see you all there. Follow the link below. 1 p.m. Eastern time. You don't want to miss out. Register. And if you're watching on YouTube, go to the description in the video. The link is there. Hope to see you later. Feedback. I want to hear from you. Support at marketgeeks.com. Pattern Trader just had 10 out of 10 winning trades. Bye, guys. Talk to you soon. Hope you are having a great summer. I want to hear from you. Support at marketgeeks.com. Bye.